We all want to leave as much as possible to our family and loved ones. In the UK, the first £325,000 of an individual's estate is free from inheritance tax. But everything over this could be taxed at 40%. Without careful planning, HMRC could easily become the largest beneficiary of your estate, leaving your family with a large tax bill to settle. There are a number of arrangements available to help you reduce your inheritance tax liability. A discounted gift trust account from Canada Life is an arrangement whereby you receive regular payments to supplement your income and can reduce the amount of inheritance tax that could be payable when you die, which could increase the amount your family receive. You invest in an investment bond held under a discounted gift trust. At outset, you will select the amount you want to receive and the frequency of the payments, such as monthly, quarterly, half-yearly, or yearly. These payments are designed to continue for the rest of your life. The trust is a legal arrangement whereby you appoint both the trustees to hold the investment and the people you want to benefit. These are the beneficiaries. You, as the investor, can be a trustee, but you cannot be a beneficiary. With a discounted gift trust from Canada Life, you can name specific beneficiaries that cannot be changed. This is called a bare trust. If you do not want to name specific beneficiaries or want to give the trustees the ability to change who benefits, you can use a discretionary trust, as you are providing the trustees with discretion. The benefit of using this type of arrangement is that any growth on the investment is outside of your estate immediately, and therefore not subject to inheritance tax when you die. Part of your original investment is also outside of your estate immediately, with the balance outside after you have survived for a period of 7 years. So how does a discounted gift trust work? Let's look at an example. Eric is 65 and invests £200,000 into a discounted gift trust to supplement his pension income. At outset, he decides that he wants to receive an income of £8,000 each year for the rest of his life. As Eric is unsure about the eventual beneficiaries and the shares they will receive, he opts for a discretionary trust, appointing his children as the trustees. Canada Life underwrites Eric to establish his life expectancy based on his age, state of health, and lifestyle. This allows Canada Life to calculate the value of the discount, which is the capital value of the regular payments that Eric will receive. Fortunately, Eric is in good health and is looking forward to a long and healthy retirement, and he receives a good discount. Had Eric been older or in poor health, then his life expectancy would be shorter. This would have meant that the regular payments would not be expected to continue for as long, and therefore the capital value of these payments would be worth less. The capital value of the regular payments is the discount that Eric receives. This discount is outside Eric's estate immediately and should not be subject to inheritance tax when he dies, irrespective of when that is. Think of it as converting a lump sum into an income that stops when Eric dies. The balance of Eric's investment is a gift and will be outside of his estate after he survives a period of 7 years. As the investment is held in an investment bond, the payments Eric receives make use of the 5% tax-deferred allowance available. Providing they remain within this allowance, there should be no immediate income tax liability for Eric. For income tax purposes, the payments are treated as a return of capital, and once Eric has received a return of the amount invested, then tax charges may occur on subsequent payments. This could be, for example, after 20 years at 5% each year, or 25 years at 4% each year, and so on. Sadly, Eric dies 17 years later, having lived well during his retirement, spending his pension income and the payments he received from the trust. As he survived 7 years after investing in the discounted gift trust, the gift he made at outset and all the money remaining in the trust is outside of his estate. Eric's children decide to leave the money in the trust for the time being, as they are all financially independent, and as the money is owned by the trustees, it does not sit in the children's estate. Between them, they decide to keep the money invested until their 4 children, Eric's grandchildren, are old enough and let them enjoy the money. The trustees then use this to help one buy a car, one pay for a wedding, and the other two get on the property ladder. Many people use investments to provide an income later in life, but in many instances the capital remaining on death could be subject to 40% inheritance tax. By gifting this capital into a suitable trust designed to provide regular payments back to the investor, the potential inheritance tax payable could be reduced.